Imagine stepping into a world where a single decision could either multiply your wealth or dwindle it to nothing. This isn't the plot of a blockbuster movie, it's the reality of investing, a world where Warren Buffett, the Oracle of Omaha, reigns supreme. With a net worth that has hit staggering highs, surpassing $100 billion, Buffett's investment choices and strategies have become the gold standard for investors worldwide. Yet, what many don't know is that his path was paved with mistakes, misjudgments, and missed opportunities that could fill a library. In this journey, we're not just glorifying success, we're dissecting failure. Did you know Buffett once invested in a company that later admitted to overvaluing its profits, leading to a loss of about $444 million for Berkshire Hathaway? Or that by hesitating to invest in tech giants like Amazon and Google, he missed out on what could have been a monumental increase in wealth? These aren't just figures, they're lessons in resilience, adaptation, and the humility to learn from missteps. As we delve into Warren Buffett, 15 mistakes every investor makes, prepare to uncover the truths behind the triumphs. Each chapter is a testament to the fact that even legends make mistakes. But here's the catch: it's not the errors that define us but how we rise from them. So, buckle up for an insightful ride through the ups and downs of investment strategies, where each misstep is a stepping stone to wisdom. Let's turn Buffett's blunders into your blueprint for investment success. 1. Starting wrong. The tale of failed companies. Warren Buffett's initial forays into investing were not without their blunders. Take, for example, his investment in the Wambeck Textile Company and Dexter Shoe Co. Both companies seemed like bargains but ultimately failed to deliver. Buffett once quipped, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." His mistake was not just about picking the wrong companies, it was about overlooking the essence of value. The lesson? Always look for companies with a strong competitive advantage that can stand the test of time. 2. Seeing but not observing. The Tesco fiasco. Buffett's investment in Tesco, a leading UK grocery chain, serves as a classic example of misjudging management and market conditions. Despite early signs of trouble, Buffett hesitated to sell his shares, leading to a significant loss. This story teaches us the importance of acting swiftly when we spot red flags. The stock market is designed to transfer money from the active to the patient, Buffett has said, reminding us that patience should not prevent decisive action when necessary. 3. Spending what you haven't got. The Dexter Shoe disaster. The purchase of Dexter Shoe Company using Berkshire Hathaway stock, which later became a financial disaster, underscores the critical importance of resource allocation. Buffett describes this as his worst deal, lamenting, "My greatest mistake was buying Dexter Shoe. I was wrong about the company, and I was wrong about the industry." This debacle reminds investors to carefully consider not only what they buy but also how they pay for it. 4. The weight of debt. Energy Future Holdings. Buffett's foray into Energy Future Holdings was a bet that went south, costing Berkshire Hathaway dearly. The investment, made without his usual partner Charlie Munger's counsel, highlights the risks of going into debt without a clear path to profitability. Buffett admits, "We don't get paid for activity, just for being right. As to how long we'll wait indefinitely." This scenario illustrates the danger of impatience and the importance of seeking advice before making substantial financial commitments. 5. Missed chances. Amazon and Google. Buffett's hesitance to invest in Amazon and Google early on due to a lack of understanding of their business models represents missed opportunities. "I had plenty of ways to ask questions or anything of the sort and educate myself. But I blew it," Buffett confessed about not investing in Google. The lesson here is twofold. Don't let unfamiliarity scare you away from potential investments, and always be willing to learn about new industries and technologies. 6. Failing to perform due diligence. General Reinsurance and Lubrizol. Warren Buffett's ventures into General Reinsurance and Lubrizol highlight the paramount importance of due diligence. Buffett's oversight with General Re, not foreseeing the underwriting losses in the aftermath of not thoroughly vetting Lubrizol before acquisition, serves as a stern reminder. Risk comes from not knowing what you're doing, Buffett once explained, emphasizing that understanding every facet of your investment is crucial. The strategy? Never skip homework. Every detail matters in the grand landscape of investing. 7. Overestimating the value of certain investments. Buffett's candid admission of overpaying for certain investments offers a lesson in humility and precision. Even the Oracle of Omaha can misjudge the market's direction or a company's intrinsic value. This teaches us the significance of conservative valuation and the danger of overenthusiasm. Buffett suggests, "It's better to be approximately right than precisely wrong," guiding investors to err on the side of caution and seek investments with a margin of safety. 8. Neglecting to invest in yourself. Buffett's advocacy for personal investment underscores a broader strategy beyond stocks and bonds. He champions the idea that the most lucrative investments are those made in oneself, be it through education, skill development, or personal growth. The best investment you can make is in your own abilities. Anything you can do to develop your own abilities or business is likely to be more productive, Buffett advises. This approach not only enhances one's ability to make informed decisions but also builds the resilience and adaptability essential in the ever-changing investment landscape. 9. Overlooking the power of compound interest. The tale of compound interest is perhaps one of the most compelling illustrations of Buffett's investment genius. His fortune, amassed not just through savvy picks but through the relentless force of compounding, highlights a fundamental principle: patience pays. My wealth has come from a combination of living in America, some lucky genes, and compound interest, says Buffett. The strategy here is clear: invest with the long term in mind, allowing your assets to grow through the magic of compounding. 10. Failing to diversify. While Buffett is known for his concentrated investments, he also warns against putting all your eggs in one basket. Diversification is a safeguard against ignorance, a concept Buffett openly acknowledges. Diversification is a protection against ignorance. It makes little sense if you know what you are doing, he has stated, suggesting that while a focused portfolio can lead to outsized gains, it requires a deep understanding of those investments. For the average investor, a diversified portfolio reduces risk and offers exposure to the growth of different sectors. 11. Letting emotions drive investment decisions. Warren Buffett has long preached the perils of allowing emotions to dictate investment choices. Be fearful when others are greedy, and greedy when others are fearful, he advises, highlighting the importance of counter-cyclicality in investment decisions. This principle underscores the need for investors to remain calm and collected, making decisions based on rational analysis rather than the herd mentality that often prevails in markets. The strategy is simple yet profound: separate your emotions from your investment decisions to capitalize on market inefficiencies. 12. Ignoring the importance of a margin of safety. The concept of a margin of safety is central to Buffett's investment philosophy. It refers to the practice of investing at a significant discount to the intrinsic value of a stock, thereby insulating oneself from the vagaries of market fluctuations and errors in judgment. You don't have to be right about thousands and thousands of companies, you only have to be right about a couple, Buffett mentions, emphasizing the selectivity and caution required in investing. The strategy here is clear: prioritize safety and ensure that your investments have room to weather unforeseen challenges. 13. Disregarding the quality of a business. Buffett's preference for investing in companies with strong fundamentals, a durable competitive advantage, and competent management highlights a key investment strategy: quality over price. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This wisdom teaches investors to look beyond short-term price movements and focus on the long-term potential and stability of a business. Investing in quality companies ensures that your portfolio is built on solid foundations capable of withstanding economic downturns. 14. Underestimating the impact of managerial competence. The success of an investment can often hinge on the quality of a company's management. Buffett places a high value on leadership, integrity, and forward thinking in the executives of the companies he invests in. When you invest in a stock, you become part owner of a living organism. Your company is a team of people with certain leadership, values, energy, and personality. You need to understand and believe in this team. This insight encourages investors to assess not just the financials of a company but the people driving those numbers. 15. Failing to stay informed. In a rapidly changing world, staying informed is not just an advantage, it's a necessity. Buffett's voracious reading habit, spending 80% of his day reading, is a testament to his belief in continuous learning. I just sit in my office and read all day. This approach ensures that he remains ahead of market trends, regulatory changes, and economic shifts that could affect his investments. The strategy for investors is to cultivate a habit of lifelong learning, staying abreast of not only market news but also broader trends that could impact the investment landscape.